Texas Insurance Training Academy. This is going to be property and casualty general lines. This is going to be chapter 1 on Texas statutes and rules. So statutes applying to Texas are going to be on section 2 of the test. So the first section is going to be chapters 2 through 16. And then you're going to have chapter 1 is going to be everything that is tested under section 2 of the test. Most of the regulation is done under the insurance under the state level. There's a couple things under federal level that we'll get out of the way first. And there also is self-regulation that does occur for businesses that choose to self-insure because they're just looking to cover themselves in a reinsurance type standpoint only versus, just setting a whole bunch of money aside. All right, so federal law, Federal Credit Reporting Act, FCRA. The thing that you need to know about this for the exam is that the insurance company nor the agent does not give out a credit report to anybody. Only the credit reporting agency will be giving that out. And the fine for violating any of the tenets of the FCRA are going to be $2,500, and that typically is going to be for the reporting agency for circulating inaccurate or incomplete information. Next federal regulation that we're going to talk about is the Graham-Leach-Bliley Act. This is for privacy protection primarily. It also informs about disclosure to third parties of information from first party. An opt-out has to be provided, and how to exercise that non-disclosure also has to be there. Another thing that Graham-Leach-Bliley Act did put in place was uniform licensing laws, which allows for reciprocity, allows for insurance agents and others to get their licensing taken care of in one state as a home state, and then instead of going to the other state to take their test, you can actually just pay a fee and put in an application, and that's all you'll need to do for that. Last federal law that we need to talk about is the Terrorism Risk Insurance Program Reauthorization Act of 2015. It is going to cover what insurance is going to exclude if it is designated as terrorism by by all three parties of the Secretary of Treasury, the Secretary of Homeland Security, and the U.S. Attorney General, up to $200 million of exposure in this fund. The U.S. president, sometimes I like to throw this one in there, is not involved in the declaration of a act as terrorism for the TRIP Reauthorization Act of 2015. All right, so now for Texas statutes and rules that are common to all lines. Transacting insurance is going to be defined as advising on coverage and claims, solicitation, negotiation, sales, receiving commission, delivering policies, etc., etc. Any of this, you're required to have a license as an agent to be able to conduct this. Speaking of licenses, a certificate of authority is called a business license for the insurer. When the Department of Insurance issues this out to an insurer, they are considered to be authorized or admitted. The state likes to have these all put in there, jumbled up in there, and use them interchangeably. The next terms only have to do with where an insurance company is headquartered versus where they're doing business. A domestic insurer is going to be one that is headquartered in the same state that they're doing business in. A foreign insurer is going to be one that is headquartered in a different state than where they're doing business. And an alien insurer is going to be one that is headquartered in a different country than where they are doing business. Surplus lines, insurance is going to be a exemption or allowing a company to do business within their state that is not considered to be authorized or admitted. The correct term for this is unauthorized or non-admitted carrier. In this case, this insurance usually is for difficult to place or high hazard insurances. And because of that, they do not compete with any of the admitted carriers for business within the state. In order to be in Texas as a surplus lines carrier, you have to be on an approved list by the TDI, and you have to maintain a capital and surplus of at least $15 million. In order to sell this as an agent, you have to have a general lines license, and then you also have to get a surplus line license to be able to sell this insurance. Financial strength rating companies such as AM Best, Standard & Poor's, and Moody's. These companies rate any financial services companies, including insurance companies, but they are not regulated by the TDI. They will use these report cards, to kind of do some evaluations, but the TDI is responsible for doing all of the regulation of the insurance companies, and they do not regulate these third-party companies. Types of insurers. So you're going to have stock insurers. These are going to be giving out what we call non-participating policies. These are going to be owned by the shareholders. Any dividends that would yield from this would be taxable dividends. Mutual insurers like Liberty Mutual are going to be participating policies that are partially owned by the policyholders. They deem dividends to be a return of premium and therefore non-taxable in this situation. You can kind of think of mutual insurers as like the credit union to a bank. Self-insurer, this is going to be setting up a savings account, and they usually will have reinsurance. Usually large companies will set aside these big accounts to be able to do this. An example of a company that does this is Walmart. Texas Lloyd's, this is a different type of insurer. It's insurance company regulated by Texas Insurance Code as an admitted or authorized carrier, so they do have a certificate of authority. A Lloyd company exists of an arrangement, an article of agreement, and a power of attorney between an attorney and a fact, either a corporate entity or person, and at least 10 underwriters. They are required by statute to have at least $2 million that is maintained inside of a Texas bank under a joint control agreement with the Commissioner of Insurance. All right, speaking of the Commissioner of Insurance, there's usually several questions on the test about this specific topic. The Commissioner of Insurance is an appointed position by the governor of the state of Texas for a 2-year term ending February 1st of every odd year. You need to know that one exactly. And most of this stuff, to be honest with you, you need to know pretty much verbatim because most of this is just memorization. The Commissioner of Insurance is required to have a $50,000 surety bond and at least 5 years experience in the field of administration of business, government, or as a practicing attorney or certified public accountant. They are required to hold no stock of an insurance company, and they are to be well informed and qualified in the field of insurance and insurance regulation. They will regulate the Department of Insurance, so the TDI is run by the Commissioner of Insurance, and their authority is delegated downward. The powers of the TDI are the same as those of the Commissioner, so anybody that you deal with the TDI has the same authority as the Commissioner of Insurance. The Commissioner of Insurance and TDI approves the rates and forms. They interpret the laws from the legislature. They do not write the laws, but they interpret the laws from the legislature. They will issue insurance licenses and certificates of authority, enforce penalties, conduct audits and investigations, issue cease and desist orders. They administer the Texas Workers' Compensation System. They'll regulate any electronic transfers in the industry over $500,000, and they will issue any probations and reprimands. They are required to do the examination of records of all insurance companies every 5 years, any new insurance company every year. The insurers will pay for the cost of these audits, but they do get to take credit for this on their premium taxes that they pay. For complaints in the insurance industry, what happens is the Commissioner and Department are required to establish a program to facilitate the resolution of these complaints. If the Department receives a written complaint, the Department will notify each party of the complaint status at least quarterly until resolved. Agents are usually not examined unless there is a complaint received. Investigations, hearings, and penalties. The TDI protects the public from both unfair trade and unfair claims practices. We'll go over both because they will separate these out sometimes on the statutes for the state exam. A general inquiry from the TDI, you are required to respond within 15 days. The TDI may extend this at their sole discretion for up to 10 days. And the agent has up to 60 days to request a hearing. The TDI must give at least 30 days advance notice unless mutually agreed upon for a later date. Reasons that the TDI may take disciplinary actions against you: commingling funds, which is mixing your funds in with customers' funds, or getting convicted of felony. If you are licensed, you must report that to the TDI within 30 days of the conviction. Violation of the Texas Insurance Code or materially untrue information on an application for a license may be other reasons the TDI may take disciplinary actions. Now, penalties from the TDI may include fines of civil penalties from $50 to $500 for a willful violation. Cease and desist orders, a fine is $1,000 for each violation, up to a $5,000 maximum for all violations. If you are found to be violating the written down Texas Insurance Code, the maximum fine for that is $25,000. A revocation or suspension of the license is possible. You can be put on probation, or they can refuse to renew your license. Now, this is what the TDI must do. They may do all those things, but they must report any crime to the appropriate authority within 30 days. Now, the end-all be-all is not the TDI. You can appeal a decision that the TDI has made to a district court if you should so choose to do so. So licensing requirements. These are kind of going to be like the steps 1 through 3 that we talked about before. The agent has to be at least 18 years old, have passed the licensing exam sometime within the past 12 months, and met all those requirements like the background check, passing the exam, and applying for the license. Agent, another name for that is a producer. Another name for that is a field underwriter. These are the people that are going to be contracted with the insurance companies to act on their behalf through the express authority granted by those insurers to act on their behalf. Agents, what they do is evaluate customers' needs, recommend coverages, bind risks, quote premiums, receive premiums from the insured, and commissions from the insurers. Otherwise, I don't think we would do this, and deliver the policies to the customers. Now, agents may share commissions only with other licensed, and they can appoint sub-agents. Now, the agent is required to notify the TDI of an address change within 30 days of that change, and it can be at a physical address only, not a P.O. box. A non-resident agent is defined as anyone that is allowed to sell across state lines. You don't have to take the other state's exam or do any continuing education for the other state. You just got to pay a fee in the application. This is that reciprocity that we talked about through the Graham-Leach-Palali Act. Agents do have a fiduciary responsibility for the insured, so you're supposed to sell the products that are going to be best financially for your customers. General lines, property and casualty license. This is going to be for all lines of personal and commercial insurance, including bonds. That's what we are testing to, or what we're prepping for testing for on this license. Personal lines, property and casualty, that is chapters 1 through 9 here, and that's only for personal property and casualty license. You can get a temporary license for up to 180 days with no examination if you have an agent sponsoring you. In that first 14 days, you have to complete 40 hours of training in order to have the conditions of that temporary license met. You also can get an emergency license issued for 90 days if you're intending to leave the business. This is intended for, like, if your spouse was the one that had the license and you didn't really get involved, for you to continue to get paid until you can arrange for that business to be sold to a licensed agent or someone else. Insurance service representative, this is a salary person, and they can quote any insurance under the supervision of an agent. So basically, the agent takes responsibility for the quoting that the ISR does, but they don't have to be licensed because they don't receive a commission. A managing general agent, this is somebody that has supervisory responsibility for an agency. It is a separate type of license. It does require a separate license in order to be able to sell insurance, but if you're just managing the agency, then you're not required to get more than an MGA. Risk manager, this is going to be getting paid compensation to evaluate the risks in policies, not selling a policy, but actually just evaluating the risks of a policy. You don't have to pass an examination for this. And titles for these risk managers are going to be certified insurance counselors, chartered property and casualty underwriters, or associates in risk management. As we discussed before, surplus lines, you got to have both the general lines and the surplus lines to be able to sell that. Agent appointments. So you will be appointed with an insurance carrier, and this insurance carrier's appointment can be terminated by the insurer. Usually it's because of a lack of business, and any termination of your appointment has no effect on your license. Controlled business is defined as sales that are made to friends, families, or business associates. This is designed to be a public use license. So for your general license, you can't have more than 75% of the business being controlled business in any calendar year.